Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Oracle.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. For this company, the old perception, the one that's all about legacy databases and old school enterprise software, that's really fading away now.
It feels like it's been fading for a while, but now it's different.
It's fundamentally transforming. You really have to see them now as an AI infrastructure and, I'd say, a cloud hyper-growth story.
Right.
And that metamorphosis is what's behind both the massive growth numbers we're seeing and, frankly, the intense stock volatility.
Okay, let's unpack that transformation. Because when you just look at the raw figures, say, from Q2 of their fiscal year 2026, you see the scale.
You do.
Total revenue was what, $16.1 billion, a solid 14% increase year over year. But like you said, that headline number, it kind of hides this huge shift happening underneath.
It absolutely does.
So where's the real momentum coming from?
It's entirely cloud-driven. And what's really crucial here is that it's accelerating.
Accelerating.
Yeah, cloud revenue is the engine. It surged 34% year over year in Q2. And for a company this big, the fascinating part is that acceleration. It was 28% the quarter before.
So it's speeding up, not slowing down.
Exactly. This isn't just steady growth. It's a reacceleration at a time when a lot of enterprise tech is actually seeing a slowdown. This one segment now makes up, what, roughly 77% of their total revenue?
So the transition is basically, it's done.
It's functionally complete. They are the cloud company now.
And when we talk about that AI infrastructure piece, we're really talking about OCI, right? Oracle Cloud Infrastructure.
That's the one. That's where all the capital is going, and it's where the explosive demand for AI compute is landing.
So what are the numbers looking like there specifically?
OCI is, it's the standout star. Its revenue growth was extremely strong. It rose 68% year over year in Q2.
68%.
And the outlook is even more aggressive. Management and analysts, too, are projecting OCI revenue growth to go past 70% for the full fiscal year.
Wow.
If you just follow that path, OCI is scaling from an $18 billion run rate business today to a projected, get this, $144 billion by fiscal year 2030.
$144 billion. That's a massive number.
Yeah.
That projection, though, it relies on, what? Perfect execution. Sustained AI demand.
It relies on a lot, but this is where we kind of shift from looking at past performance to looking at future visibility. And the metric you have to watch is RPO.
Remaining performance obligations.
Exactly. It's the amount of signed customer contracts that they haven't delivered on yet. This number, this RPO, it's the foundation of the entire bullish case.
And that figure it's just unprecedented.
Staggering. It hit $523 billion in Q2. And to put that into context, that is a 438% year-over-year jump.
438%?
Yeah. This backlog, it didn't just appear. It was driven by these multi-billion-dollar, multi-year AI deals with huge anchor tenants. We're talking about Meta and NVIDIA.
Okay, so that number isn't just a big number. It's a signal.
It's an unprecedented signal that AI capacity demand is front-loaded and, highly concentrated with the biggest players.
That kind of jump, a 438% jump, it suggests the market is willing to sign these long forward contracts right now and just ignore any near-term noise. But if you're listening to this, you're probably asking, is that $523 billion really guaranteed revenue?
That's the right question. And the answer is, it's very high quality, highly visible future revenue.
So not tomorrow, but soon.
Right. It's not all recognized tomorrow, but about a third of it, 33% of that massive RPO is expected to convert to revenue within the next 12 months.
Okay, so that gives them a really strong, reliable look into their top line growth.
An unusually strong one. It basically acts as a buffer against, competitive pressures, and it offsets a lot of the execution risk you normally worry about with a build-out this big. The customers are already there, just waiting.
That RPO definitely makes the growth case compelling, but let's pause for a second. We all know the cloud market is dominated by AWS, by Azure, by Google Cloud.
Hyperscalers, yeah.
So holding $523 billion in commitments only matters if you can actually deliver without getting crushed in a price war. How do they defend this new pipeline? What's the moat?
That is the critical question. And their position is, I'd say, dual-layered. It's built on both their deep legacy dominance and a really unique modern strategy.
Okay, so what's the legacy moat?
The legacy moat is simple. Switching costs, their relational database and Fusion apps are absolutely mission critical. They're used by over 90% of the Fortune 500.
And it's just too hard to rip that out.
It's too costly, too risky, too complex to switch away from it.
Yeah.
So that keeps the lights on, generates stable cash.
Right, so that legacy stickiness keeps the existing customers from just jumping ship to Azure or AWS. But the new growth, the AI deals, that demands a totally different kind of moat, doesn't it?
It does. And that's where the new moat comes in. And it's this strategy of cloud neutrality.
Cloud neutrality.
Yeah. While the big hyperscalers are in this zero-sum game, trying to lock you into their one environment, this company is taking a more collaborative approach.
How so?
They're actively building 72 of what they call multi-cloud data centers that are physically embedded inside the regions of AWS, Google Cloud, and Microsoft Azure.
Wait. They're running their own physical infrastructure inside the walls of their biggest competitors.
That's right.
How does that even work? Isn't that a huge logistical and, frankly, competitive challenge?
It is a profound strategic compromise, but it is one that's paying off in a huge way.
Okay.
It lets them serve customers who need the power and the cost efficiency of their specific database tech, but who also want the flexibility of a multi-cloud world. They're becoming the go-to partner for complex enterprise workloads.
And is there any proof this pivot is actually working?
The proof is in the numbers. Look at their biggest multi-cloud project, the Oracle database at Google Cloud. It just launched. It is the single fastest growing segment in the entire company. It showed an 817% year-over-year revenue growth in Q2.
800%.
817. It proves there's this huge pent-up demand from customers who want that database performance without being locked into one of the other hyperscalers.
That really is a fascinating strategy. And I guess to keep those customers sticky long-term, AI has to be integrated everywhere.
It has to be embedded across the entire stack. That's how you maximize switching costs. So it's in the infrastructure, OCI, it's in their autonomous database, and crucially, it's in their applications.
Right.
They've already got over 50 AI agents built into their Fusion Cloud apps, and they're targeting 600 or more new ones.
So things like AI-augmented workflows for HR, finance, all that, it's just built in by default.
Exactly, which locks customers in even deeper. Plus, they've got validation from the biggest players. They claim that all of the top 5 foundation AI models are running in their cloud right now.
So that validates them as a real preferred compute partner.
It does. It moves them beyond just being a niche player.
Okay, that makes for a powerful growth story. But let's shift gears to the financials, because this is where the skeptical investor gets, a little nervous.
This is the trade-off.
Right. This build-out needs a staggering amount of cash. And while profitability is expanding, net margin is up to 25.3% on $61 billion in trailing revenue. They are in a massive investment phase.
A massive one. And it is the ultimate strategic trade-off. It's the source of all the volatility in the stock. To capture this AI opportunity, they're projected to spend roughly $50 billion on capital expenditures in fiscal year 2026 alone.
$50 billion in 1 year.
All dedicated to building those AI data centers and expanding their footprint. It's a massive front-loaded cash outlay.
And how are they funding this? Because a lot of the bears see this CapEx as, a desperate attempt to catch up, not a sign of strength. They say they're leveraging the balance sheet at exactly the wrong time.
And it's true. Funding this has led to some short-term negative free cash flow. And to do it, projections show they might take on nearly $200 billion in new debt on top of their existing debt.
$200 billion. That's a huge risk.
The balance sheet is absolutely being leveraged aggressively to seize this AI moment. There's no question about it.
So what's the bullish counter-argument? How do you mitigate the risk of that much debt and negative cash flow?
The mitigation is simple, and it comes right back to that RPO figure. That $50 billion in CapEx is not being spent on a guess.
Right.
It's a strategic investment to serve the long-duration AI workloads that are already contracted under that $523 billion backlog.
So the contracts are essentially the collateral for the debt.
Exactly. They are not building and hoping customers will come. They are building because customers have already signed the contracts and are just waiting for the capacity to come online.
So the high CapEx is just a necessary evil to turn that RPO into revenue.
It's a timing gap issue, not a demand issue. And they still generate substantial operating cash flow, about $22.3 billion in the last year, which gives them a buffer. The expectation is that free cash flow will recover very, very strongly as these data centers come online.
We also saw a pretty savvy move from them last quarter on the asset management side.
We did. They made a strategic move that generated a $2.7 billion pre-tax gain. They sold their stake in the chip design firm, Ampere.
And that helped boost their GAAP EPS by what, 91%?
It did, but it wasn't just a cash boost. It was a strategic signal. It confirms their commitment to what they call chip neutrality.
Meaning they're getting out of the chip design business themselves.
Right. They're focusing capital on software and infrastructure and just buying the best AI chips from NVIDIA, from AMD, from whoever has them. They decided not to compete vertically with the hyperscalers on chip design.
A very tactical move. So let's pivot to the technicals. We mentioned the volatility. The stock has seen these sharp pullbacks, sometimes up to 42% from its highs, tied to AI jitters and those CapEx concerns.
And that volatility is the perfect picture of this tension between the long-term vision and the short-term financial pain.
But some analysts see this differently.
They do. Many technical analysts view this as creating an accumulation setup. They point to a clear pattern of higher lows on the chart.
Suggesting that the big money is buying on the dips.
Exactly. They're using those dips to buy in because the fundamental floor is provided by that massive RPO backlog. So fundamentally, the picture still looks pretty constructively bullish.
So if you're tracking this thesis in real time, what are the near-term catalysts the market is watching for?
The next big one is the Q3 earnings release, which should be around March 2026. The market will be laser-focused on two things.
Okay, what are they?
First, they have to show that total cloud growth continues to accelerate toward that ambitious 40+% guide for the full year. If that stalls, the story falters.
And second?
Second, investors want to see more RPO expansion. They need to prove that the demand isn't just a one-time thing from Meta and NVIDIA, but a continuous pipeline.
And what about catalysts outside of the earnings report?
You'll want to watch for updates on their global footprint. They have over 211 regions planned or live, so any new sovereign or AI cloud region is a catalyst. Also, any concrete updates on the utilization of that new capacity, especially that Google Cloud partnership.
And then there's the macro picture.
Right. If the Fed starts signaling rate cuts, that would generally be a tailwind for a name like this, with so much contracted future growth.
So if we boil it all down for the listener, what's the single core conclusion here?
The core conclusion is this. The company is making this huge strategic trade-off. They're placing an enormous financial bet with all this CapEx and debt.
But that bet is backed by an even bigger order book.
It's backed by that $523 billion RPO, and their unique, multi-cloud, chip-neutral strategy is solidifying their role not just as a competitor, but as a key enabler for the entire AI ecosystem.
So the big question for the next few quarters really is about execution, isn't it? Can they manage this incredibly fast build-out and start converting those AI contracts into real strong free cash flow?
Execution is absolutely everything now. They have to prove that the leverage they're taking on today is justified by the ambition.
Don't forget to subscribe, like, and comment below to join the Smart Wealth community. We'll be back tomorrow with another deep dive.